Hi, Jeff. How are you? So nice to see you.
Nice to see you. I'm doing lovely. And how are you?
I'm doing great. We met at ValueX. We got to spend a lot of time chatting about all kinds of things, and I was really looking forward to having you on the show and asking you some questions. And I don't know, I mean, even before I hit record, we had this wonderful conversation that I'll want to come back to somewhere halfway through this discussion about the environment, how we think, how we operate, how we're productive. But I want to jump right in and I want to ask you about the early days, childhood, upbringing. Looking back, how do you think that time influenced who you are today?
So there's numerous things in one's childhood that forms your foundation, right?
Uh huh.
Um, so I wasn't the best student, but my parents put an extreme value on education. In fact, the two things that they were really big on were values
Mm-hmm.
and education was unlimited. And it's not that they were so affluent, but they would pay for literally any post-secondary, any private whatever they thought I needed. That for them, they would put all their resources towards. So that's one layer of foundation. But I want to share with you perhaps the most meaningful story from my childhood, which involves my grandfather. So I was in maybe grade, I don't know, 8, and I was eating Doritos in the basement, watching TV a lot in the summer holidays. My grandfather did not approve of these activities. And he said, "Boy, it's time to go for a walk." So I went for a walk. Fine. We're walking around the local area, and this is up in Canada. And my grandfather spots an individual with a land surveying equipment, if you know what that is. So a land surveyor.
Uh-huh.
The individual's young. Maybe they're in their 20s. My grandfather taps the guy on the shoulder. "Excuse me, what are you doing?"
Uh-huh.
Well, it turned out the city was putting in a new sidewalk. They hired land surveyors. Fine. My grandfather, "How do you know where the sidewalk should go? How do you know the slope?" And I don't know if you know, but there's magnets, which determines the exact location in terms of what title of land. So who owns what is determined by that, and it's in the ground. My grandfather asked if he could see the individual's notes from the land surveying. And he asked, "Are you using trigonometry? Are you using geometry?" My grandfather asked if he could look through the binocular part. He wanted to know, how was it that it was level and even? How does he know? How do you know the accuracy behind the equipment? My grandfather had been retired for, I don't know, 15, 20 years. Like I couldn't believe the questions. 20 minutes, he's forensically interviewing this guy.
Uh-huh.
And as I'm walking away, I'm like, Gramps, I got to ask you, what's the deal? Like, what do you care? And my grandfather said, that's not the way to go through life. Treat your brain like a sponge. Practice continuous learning. Don't ever stop learning. Fine. My grandfather, with maybe a grade 12 education only, if you were to go to his house, he'd have textbooks like Harvard, nutrition, like big, thick textbooks. This was what he was reading. So he
Uh-huh.
didn't just tell me this, he practiced it. It took me about 10 years to realize how bright that guy was. And then I've read a book a week ever since. So, for those of you who have influence at all over anybody in their developing years, remember my story and my grandfather's wisdom, because man, it could impact people in very meaningful ways. Perhaps I'll
What?
tell you one or two more quick stories, which was my first jobs, besides babysitting, like as a teenager. But man, were
Uh-huh.
these informative too. So my first job was at a restaurant. The restaurant didn't pay their taxes, and so the police came and seized all their assets, and that was
Uh-huh.
the end of that business. The next job I had, to remain anonymous, the name of the place, but
Uh-huh.
the individuals in charge were substance abuse problems, and they went bankrupt. The next place I worked was for a major corporation, like finally a huge company, da da da. I worked in internal audit, I worked in procurement, and one day almost all of the C-suite were terminated with cause for expense claim manipulation and inappropriate spending.
Uh-huh.
And so this helped me understand that what I'm reading in a textbook is not necessarily what's happening in the real world.
That's
um,
very helpful to
yeah.
know. What I'm hearing in the first part in the story about your grandpa, I would say it's curiosity. This undying curiosity I had Tom Morgan on the show, who calls himself a curiosity Sherpa to the billionaires. And curiosity is such a powerful force that engages us in life and allows us to pursue different things. I mean, even this podcast itself, to me, each episode, I'm just curious about the person I'm talking to and what they have to offer. And I never really have like a clear plan. Well, obviously I have the questions that you're familiar with and you know what's coming, but I'm always surprised in wonderful ways when my guests bring, stories, experiences, and right this minute I'm hearing myself on your end.
The I think it was a book that I read called Start with Why.
Mm-hmm.
And Charlie, sorry, I'm a huge Charlie Munger follower. Charlie um, wrote about this engineer. I think he was in oil and gas, and he said every single email, every single letter, every memo has to have a why.
Mm-hmm.
Otherwise, it's literally cause for termination within his company. And I love this way of thinking. Um, like, people, my grandfather used to talk about people with their blinders on. He would do horse blinders, from a different generation, obviously. And those are individuals who he deemed not to have the intellectual curiosity, not to have their why brains on. And it's fun. It's a fun way of looking at the world. He would walk into Walmart and he would ask me, what makes the store different? Do you think they have good inventory management practices? Do you think that the employees are well trained? What's their real differentiation? This is what a fun way of viewing the world. I can't turn it off. Every
Mm-hmm.
store I go into, my kids know this well from me. I'm constantly doing some sort of analytics, some sort of math, and also like trying to figure out qualitatively, is this a good business? Is this a bad business? What's going on? But it's not even just pure business. It's frameworks, philosophies. It's everything.
The second part of what you were telling me in the other stories was you came across fraud or bad business practices, right? So curiosity on one side, bad practices. And since I know you, I know where this is going, which is your career. But before I ask you about that, I'm curious at what point you discovered investing. Your grandpa, by the way, sounds like he was or he is an investor or somebody that could use that curiosity to finding business opportunities. So you can mention what he did for a living. I'm curious to hear that too. But at some point, tell
My
me about,
grandfather
your discovery of investing.
was a traveling was a traveling salesman.
Uh-huh.
And so, he sold TVs. And there's some fascinating stories that he'd tell from his travels throughout all of, rural areas and what have you. I wouldn't describe him as an investor, um, uh, but I would describe him as an extraordinarily wise individual. Um, so he believed in certain things like a solid foundation. I remember one conversation in grade seven, and he's like, Jeff, you've taken enough math now to do what's the cost of renting versus the cost of ownership of a house. Um, Now, he had some side investments or whatever he did, and he was able to retire. Um, but what I want you to think about is his years of in sales, how many stories he's heard, and how many people he's met. And then I'd like you to think about the level of skepticism that he had, meaning, could you take advantage of somebody like my grandfather? And I wish you the best of luck. Even the most advanced of fraudsters. He had a skill that was similar to Charlie, which I'm still trying to develop, where Charlie was able to quickly size somebody up. And by the way, a hint, because they asked Charlie, how do you do this? He said, well, one of the first things he does is he assesses not what they say in an interview, but how they treat his receptionist. If they treat his receptionist dismissively, or a waiter dismissively, that lets you know the true personality of the individual, not just what they're saying in terms of how smart they are.
It's a red flag right there, how they treat other people. Investing is a peculiar pursuit because that curiosity that you mentioned, looking how the store works, how do they treat employees, what's the cost structure, you can actually deploy all of that seemingly random curiosity in a certain direction where it helps you identify potential investment opportunities. So I want to know at what point you discovered that the world of investing and you found this passion for this particular field?
I discovered investing maybe, well, okay. First of all, I did everything by mistakes. So the first thing I bought was like a mutual fund with a load with an MER that was like 3%. I just got royally ripped off. And of course,
Mm-hmm.
I was subject to expert bias from some sort of supposed expert and what have you. A whole bunch of root cause reasons for that. Where it starts getting more interesting is when I got into day trading. So I read some books and I'm like, oh, I'm a trader. Look at me go. And I bought a stock and the stock did amazing. It doubled within 1 year, which of course was one of the worst things that could have happened to me because I
Right.
thought I was a genius and I was absolutely not a genius.
Mm-hmm.
And day trading ended up being completely a disaster. In fact, I still own one stock where I went down, I don't know, 89%. And it's a reminder. I keep that because it's low amounts. I keep it. Here's what you not. Forget who you are. This is what you're not. And sorry, on my trilogy of mistakes, the last one I did was I became a copycat investor. So I'm
Uh-huh.
like, okay, who's the biggest genius I can find? Oh, everybody
Uh-huh.
follows Warren Buffett. He's too popular. I found Lou
Mm-hmm.
Simpson. I'm like, okay, I'm going to copy whatever Lou Simpson does. And I did that for a bit. And that was a huge mistake. And Lou Simpson, by the way, was a genius. It's not a mistake to shamelessly copy part of what he did. So here's what I really started learning. I'm not Lou Simpson. I don't know what he knows. I'm not sitting there reading what he's reading in that big library of his. And I don't have the same portfolio as him. I don't have the same risks as him. What I then learned was no, you want to reverse engineer what Lou Simpson is doing, why he's doing it, and you want to develop a circle of competency yourself. That led me to
Right.
value investing. That led me to Monish and Guy, Warren and Charlie, and not shameless copying, but copying their positive attributes. So now I use what I call the watch list theory, which is I very, very carefully, I need to understand the business thoroughly. I need to value the business and not value with discounted cash flows to the exact penny, a
Right.
range of what I think a business is worth with a margin of safety, with understanding qualitative factors, trust, economic high ground. I have a watch list or I have a checklist that is now, I don't know, 55, 60 items before you can make it onto my watch list. And from there, I discovered what I would call internal alignment, which is huge. I'm not Warren. I'm not Lou. I'm Jeff.
Uh-huh.
And so, for example, if you and I were to play poker, I don't know if you're a poker player. I, I'm I'm not a prodigy in poker. I'm an okay poker player. Now, the reason I'm okay is I have a lot of patience. I'm willing to sit there and fold for hours. I don't care. I'm waiting for the good hands. If the good hands don't come, now if you were a very strong poker player, you would blow right by me. You would just take my money over the long run. No, that's because you have more skill. You could read me. You could read how conservative my play is, etc. But being very patient does pay dividends over the long run with value investing because I don't buy until it meets my criteria. And what will happen statistically is approximately once every 10 years is going to be a downturn, or even not even a downturn. If you were to study a 52-week range of a great company like Costco, it's up and
Mm-hmm.
down sometimes 30, 40% within a year. Now, if you have a checklist, if you have a value, if you have a margin of safety, if you have a whole bunch of criteria, and then you buy and hold, the next thing is when do you sell? Once again, I was goofed in the past because I had no clue when to sell. Well, should I be adding or should I be selling? Because I didn't understand it well enough. Now I have rules for selling. And like I love to buy and hold and just wait. Don't interrupt a compounder. But maybe your thesis is wrong. Maybe the economic environment changed. Maybe management changed. Maybe they're not trustworthy. Maybe the capital return on capital potentials changed. Maybe the risk profile changed.
Right.
That's all okay. Um, so I think you could see the evolution of my
Mm-hmm.
thinking over time to where I'm at now.
It made me think there's this idea that you can watch what other people do, copy, and maybe do okay. I'm thinking of chefs. I don't know why, but I'm thinking of chefs. How, and there's so many shows about chefs, famous chefs. I think in the first stage, they want to be just like the people they admire. They even go and work in their kitchens and become their cooks and sous chefs. They want to emulate the master. And then at some point they discover that there's a certain voice, their own voice, and maybe that voice should be a bit louder. And they go back home, wherever home is, and they tap into the local cuisine in South America, in Scandinavia, in Asia, and they leave behind what they learned, the classic, whatever it is, French cuisine, let's say. And they find that, well, the principles, the rules, and might be the same, and they apply. But I wanted to make it mine, in the sense, what kind of a portfolio would really work for me and my clients, not exactly the same way as any of the mentors that we worship or that we follow that got us inspired at the beginning. And I think that revelation is really interesting, and it's a certain stage in the education of an investor when you allow that inner voice to come to the surface, and it's the checklist that you talk about and your own flavor of investing that really works with Jeff. And if you look at the portfolio, this is Jeff's portfolio. This is no longer the Simpson portfolio. This is a fascinating moment.
100%.
Yeah.
The key question is not, are your returns better than Bill Ackman or better than some index over 1 year? The key question you want to ask is, do you have the correct discipline, internal alignment to go where you want to go? It's a lot of internal benchmarking. I think the analogy to a chef is appropriate. And if you think about it, I think there's certain people that are just born to do certain activities. That's the ultimate in internal alignment. And I mentioned a prodigy, Daniel Negreanu, the way he plays poker, I think is a prodigy, like a genius, and ever evolving and ever learning. And so, I spent a lot of time thinking about, where is it that I want to go? In other words, do you want to be Warren Buffett in all that it takes? And the answer for me is no. So you have to be very honest with yourself, right? Like, I'm not willing to give up that much of my work-life balance to have the life that he had and is having. And that's okay.
I'm also thinking about the journey itself. If your goal is to have $1 billion or $1 million or whatever the number it is, but how do you get there, right? So we know that if you buy one single stock that takes off and goes up 100 times, that's one way to get there. And having a portfolio of 10 stocks, that's another way to get there. And a more diversified option, 30, 50, whatever it is. But the journey, when you look at, and I'm thinking of, Chris Mayer, 100x stocks, Phelps wrote about them too. When you look at the journey, if you held one stock that went through the 50, 60% drawdowns, it's an incredibly difficult journey to be on and stay on for a lot of people. And to finding the kind of destination that you talk about, but also, how do I get there? And you look at the top of the mountain, and there are many different trails to go up that mountain, and you have to find the trail that works for you and for your clients. And it might not be the one that will have the 60, 70, 80% drawdowns in between. Maybe this one is not for your stomach. Maybe there's another way to get there.
Top tick to bottom tick, I own some Berkshire stock. I've had it twice where it went down by more than 40%. I sleep very well at night with it down 40%. Almost no effect on me. That's expectation management. That's because I've read enough. That's because I learned enough to expect this. That's because my brain actually kind of gets excited. It's like, oh, this might be a great buying opportunity. Now, if you have that kind of philosophy and mindset, a 40% drawdown, almost no effect. Now, if I had a Lou Simpson stock that I don't understand and it goes 40% down, it's a very different effect cognitively. I love sleep at night stocks. I'm not worried about it. I'm not worried about what the market does over the short term. Long term, I have a lot of faith and trust in management, in the company, and in my thesis. That degree of conviction results in excellent sleep at night. By the way, pervasive throughout this is ethics. if I don't see quality management who are acting ethically, if I don't see potentials for win-wins, and I'm talking for the customers, for suppliers, for the company itself, and for the shareholders, I'm out.
Mhm. Yeah, if you can't trust them, it's a pickle. I wanted to bring up one more point before I ask you about your accounting background and how that helps you in investing. Investing as such as a pursuit is very peculiar because in many fields we think that there's just one winner. Like if you want to be the fastest swimmer, there's just one that's the fastest swimmer right now, and the second one or the third one we don't even remember who they were. But in investing, going to Omaha, sitting in that room with all those people, shareholders of Berkshire, I'm thinking, yes, Buffett might be the richest person in the room. Or maybe there was somebody else in the room at the time that was richer. I don't know. But anyways, it's a wide range of outcomes. And Munger, who is no longer with us, had a fraction of the wealth that Buffett had, statistically, mathematically speaking, right? But he was very happy with what he had. And there are people who have 1,000th of what Munger had in that room. And they're probably very happy with what they have. It's a very peculiar pursuit that not only different destinations, not only different journeys, but the number itself, if that's how you want to look at it, your net worth, you don't have to be the $100 billion person in the room and still have done okay for what you need in your life, given the context that you hinted on, your life balance and so on. I think that's what's attractive to it, among other things, is that I don't have to be number one in the sense of accumulating the most wealth and do just fine by my own benchmark.
I forget whether it was Warren or Charlie. Said it's not greed that rules the world, it's envy.
Mm-hmm.
If Bill Gates walks into the room and you're envious of Bill Gates, I believe that's a choice. I think that you could condition yourself out of it. I don't. I feel no envy whatsoever. Great, the guy has billions. Fantastic.
Mm-hmm.
That's not my goal. I think it was Gautam Bide who
Got bait.
said,
Mm-hmm.
yeah, I have what a lot of people don't have, enough.
Uh-huh.
It's a very powerful statement.
It's very true.
Speaking to what you're right. And the other thing too is I also want to eliminate stuff where a massive short, for example. I don't short anything.
Mm-hmm.
Now, I have a lot of respect for short sellers. I think that it requires remarkable conviction and remarkable insight, and I think they put their money where their mouth is, and they have a lot of risk on the table. But if I were to meet one, and I have, I
Mm-hmm.
want to interview them. I want to understand it. I want to develop a better circle of competency to put myself in their shoes and understand what it is that they're doing. But if they're successful at it, I don't want to be envious of it, nor do I necessarily want to copy what they're doing. It's not who I am. Like I don't. That's not what I want. So yeah, knowing that I think is huge.
Well, short selling specifically, since you brought it up, and it will lead to more questions in a minute about fraud and different dangers that I know you're good at identifying. To me, short selling has a limited upside, unlimited downside. And upfront, it creates an unattractive risk reward for me. When I think of a stock on the long side, let's say I have $1 million and I buy $1 million house. Let's say that I bought it at the right time, right place. It will appreciate, but it will not be 100x unless the currency gets completely devalued. Then yes, in nominal terms, it could be 100x. But a business, if I buy $1 million worth of a business that has a long runway, great potential, it will open up, I don't know, stores around the country, around the world, or launch the product to all the markets in the world. I could have 100x. Like the upside is so appealing, so that even if my timing is imperfect, even if I don't have enough to buy, the potential is very open-ended. I'm not saying every single stock will be 100x, I wish. But the fact that there are companies out there that can be 5, 10, 20, 50, 100x, the open-ended opportunity, kind of an open horizon, that's really appealing to me. Jeff, I'm curious about your background, your accounting background. So accounting to me, it's a language in itself. And when we talk about business, accounting allows us to understand and interpret reality on a certain level. And if you can tie it back to things that we have to avoid that you hinted on, given your early work experience and your entire work experience, identifying frauds and dangers. Tell me about accounting playing a role in your investment career, and then that very sensitive, I would call it a radar of sorts, that allows you to pinpoint frauds and dangers out there that are as important as the open-ended upside.
So, yeah, I'm a CPA by training, and I do work with CPA where I teach. The accounting is an amazing invention, and is very good at approximating history of a company. Now, this is a very important point. It's the history. Now, reading a balance sheet, income statement, statement of cash flows, and notes is very good for analytics. It's very good for comparability. It's very good for understanding a business. And if you do this over time, in other words, if the business is old, or if you do this over multiple businesses, you start getting a lay of the land. You start getting feelings for things. That's great. What people mistake is the past is going to represent the future, not necessarily at all. And the other thing, so future-oriented financial information is very different than historical. The other thing is that people don't quite frequently get wrong is they think accounting is like science. Oh, the book's balance, it's right. Accounting is a bunch of estimates. Do we capitalize our expense? There's allowance for doubtful accounts. There's amortization schedules. Like you name it, there's intangibles. Do we write them down or not? Everywhere you look, there's management estimates and assumptions, and fine. So understanding this is useful. I won't invest in a business until I've read annual reports, and almost more importantly, their competitors' annual reports. After I did my CPA and all that kind of stuff, I also did a forensic accounting degree from University of Toronto. And there you learn a different side. Where can things be manipulated? So just as an example, statistically, the largest frauds, the biggest frauds, are financial statement manipulation, which if you think about it, Enron and WorldCom, that's what's happening, which makes sense. They're publicly traded, they're large cap, and there's manipulation there. This is where you end up with this multi-billion-dollar huge, and not just petty cash being stolen. In 2002, Warren, I think it was 2002, might be 2001, Warren and Charlie both went off about accounting standards and some of the problems with it. As an example, they said, who the hell created these standards that don't require you to expense stock options? What the heck is a stock option? Well, it's a form of compensation of management, clearly. It's going to dilute your equity. It's compensation. It's exactly what it is. For some reason, the standard setter says it doesn't need to be recorded in the income statement as an expense. And both of them, Charlie more colorfully, described it as corrupt and ridiculous. So you can see here there's levels. Now, okay, first of all, of the S&P 500, how many actually chose to record it as an expense? Only 2. 498 chose not to record it as an expense when that option was allowed, which tells you, the environment and the culture that is Wall Street. The next thing to mention is there's a book called Financial Shenanigans. Financial Shenanigans I highly recommend because it's not a complicated book, but stuff like how management is talking, changes in estimates, and they give you actual examples of, let's call it manipulations. And it's not always a pure fraud. In order to have fraud, you have to have an intentional misrepresentation. Some are not necessarily a pure intentional illegal manipulation, but they're playing within the rule book, within the gray. Then I'd like you to compare that to the way Warren and Charlie talk in their annual reports. The difference just screams to me. And sorry, related to the accounting training, because I teach audit and I do a lot of work in audit, there's lots of focus on accounting, but auditing has some lessons in and of itself too. And so auditing would say, what's your highest level of evidence? So if I was auditing your firm right now and I asked you, are your revenues up or down? And you said, we got some new clients, so revenues are up, and we also had great returns, whatever. That's one thing. You said something to me. It's another thing where if I were to go to your bank and say, hey, can I see your bank statement? Now I have an external confirmation. That's another level of evidence. Another would be internal documents that your company is producing.
Mm-hmm.
The highest level, though, is not any of those. The highest level is, what do you know? Your personal knowledge. So, for example, if I was auditing Cedar Fair, that's a huge, roller coasters and all that kind of stuff. And there was a particularly, I'm auditing drink sales, and it was particularly hot that summer, or it was particularly cold and rainy that summer. I have expectations of what sales of a cold drink are going to be.
Right.
And I bet you anything it's going to be correlated with the weather.
Mm-hmm.
If not, there's going to be some extreme reason why not. That's what I would call analytics, right? So your own personal knowledge is the highest level of knowledge. That theory in auditing is also applicable in the real world for capital allocation, for philosophy, for making decisions, for everything.
I love the point that you made that accounting is not science. It's not fixed. It's up for interpretation. There are estimates and so on and so on. And the rules are not set in stone as much as we think. The intangibles, the assumptions that you mentioned. Now, there's this idea when you're playing a game and you're playing well within what's the acceptable, okay, legally and ethically. And then you can come up to the edges. And some companies that you mentioned, like Enron, clearly dancing over the edge. And you made a couple of points that really made me think, the 498 companies at the time that decided not to expense stock-based compensation as an expense. And it became an acceptable thing to do. I'm thinking in terms of actual massive fraud where I'm lied to, I'm cheated, and it's basically a form of theft, right? I think that's as simply as I could put it. It's easier to say when you see a guy that runs in and steals a loaf of bread. There's a book written about him and a movie. It's much harder in the business and accounting world where was the bread really stolen? Maybe the bread wasn't even there, and on, and it's up for interpretation. All this, what I'm trying to say is that the majority of the businesses and the majority of the people are operating, I hope, and I still believe, well within what's ethically and legally okay. It's the ones that are trying to dance with the edges that can get us in trouble. Is this the right way to look at it?
I have a personal theory that's non-scientific.
Okay.
So let's call myself an amateur historian, amateur data scientist, but it's all amateur stuff.
Uh-huh.
I have an uncle who's uncorruptible. This is true.
Mm-hmm.
He won't do anything even close to. So if you say to him, I'd like to cut your lawn. If you pay me cash, it'll be $100. If you want a check or credit card or whatever, it's going to be 150, 130. Now, what are they doing? Well, they're taking the money, they're putting it in their pocket, they're not recording the taxes.
Right.
We all know this. We all get this inherently.
Uh-huh.
This uncle of mine will say, I want an invoice, and I'm going to pay you by a check.
Okay.
So he lets the ground be known. He's not up for, in other words, there's a very special select few of people, and I'm going to call it 10%, who are uncorruptible. They have the highest morals and the highest ethics. The vast majority of people aren't like this. The vast majority of people are in this middle huge block. Now, these are people who would download a song off the internet if it's free. They'll stream a movie potentially for free. Do you know what I'm saying?
It feels like a small thing to do. It's not a big deal. It won't hurt too many people. Yeah,
exactly. Now, they would never go into a grocery store and steal the cost, reputation, the embarrassment, just a whole litany of reasons not societally acceptable, However, if they're given the right opportunity and it's the right culture and or if they're in a desperate time, they will push that edge of what they. So the culture of a place, the tone from the top, the average employee at Enron would fall within that. Right? They do whatever they can to get the compensation because the stock compensation or bonus is the culture of the day. Do whatever it takes. Stomp on people's throat. That's from the movie Enron, the smartest people in the room. Uh, and, and so that's the culture, that's the ethos of the place. There is another percentage of people who want to do whatever it takes to get ahead.
Right.
And so those individuals will claw their way to the top. It's those individuals,
Mm-hmm.
they see it as a win-lose. They also see it as a massive ego thing. They also see it as, um, basically you deserve to be taken advantage of. And you can see some disassociation. There's also, by the way, psychological factors that come into play with this. But there is a certain segment or percentage of people who will do that if they're given enough power and authority and they're in markets or they're in a position of trust within a company, they'll take advantage. So this is kind of how I divide up the world. Ridiculously honest ethicals, the vast majority of individuals who won't but for, and then individuals who, will do whatever it takes.
I think it's a fair assessment. I want to overlay it with the idea of being a stock market investor. And I have a question for you in a minute about private and public businesses, because I know you invest in both, but stock market as an invention. I had Guido Alfani on the show, who was talking about the history of the rich throughout time. And there's this moment in history where the joint stock company was invented. And many things were happening, but like if you were to draw a line and create a theme here, is that there's a moment where the business, trade, commerce, and so on went from a small group of people that knew each other to inviting an outside shareholder, somebody you never met, somebody who's not a family relative, but you want their capital and you are in a position to grow that capital for them through a joint stock company. I'm simplifying a big historical theme. But one of the things he brings up, which I like, was that actually role of women grew at the time because women could participate in those commercial deals much more through the newly born securities markets that were happening in Florence and around Europe at the time. All the way to today, where you have a stock market where you and I, as Peter Lynch told us and many others since, we can go in with any amount of money and become shareholders in businesses. In many parts of the world, when somebody invites you to a deal, you might be just simply cheated out of your money. But if you have a stock market with disclosures, rules, regulations, and even the culture, I think the culture is even more important sometimes than the rules and regulations, that you respect the minority shareholder. Sitting in the middle of Omaha's meeting, I look around and I wrote an article about it, how I had this feeling how the stockholder, the shareholder, is the one on the pedestal here. The way the letters are written by Buffett and so on, that you as a minority shareholder in a joint stock company will not be cheated out of your money. It's a very powerful concept that allows for everything else we talk about to happen, for us to become investors. And it has to rely on the assumption that majority of people, or enough of them, follow enough of written and unwritten rules that for me as a minority shareholder and you as a minority shareholder, that we will be treated relatively fairly. There is a lot of nuance to it and so on. And obviously, a great reminder that there's some business partners in it all, some businesses, Enrons of the world, that we should just stay away from because they'll find a way to cheat us out of our money. Do you have some thoughts about it? I drew a whole big picture here that's been on my mind.
The former CEO of Costco goes to a garage sale, buys a door, flips the door over, and that became his desk. So every single person meeting with the CEO sees an old doorknob sticking out from the $5 door.
Uh-huh.
What kind of culture is that? What kind of ethos is that? Is this the kind of place that you're going to go and have a Michelin star expensed lunch?
No.
The tone is set.
Mm-hmm.
It's a very powerful idea that I'm a partner in Berkshire Hathaway.
Mm-hmm.
Now, of course, I don't have significant stake as per, right, as per, actual percentage. It's
But it
material
could be
for me,
significant to you.
immaterial for them.
Exactly. Mm-hmm.
However, I consider myself to be a partner. Now,
Mm-hmm.
things become very different, and we'll touch on private versus public. I have more influence with a private. If I do a small deal with a friend, with a business, active management of a rental property or something, that's a very different deal than Warren Buffett deal that I have. But in some ways, it's the same mindset. I need to do due diligence. I need to understand the business. It must be within my circle of competency. Do I trust them? If I don't have that trust factor, I'm out. That trust factor, by the way, is pervasive. How are they
Mm-hmm.
treating their employees? As you could probably tell, I'm a Costco shareholder. You're a long-term Costco employee,
Mm-hmm.
you get treated quite well. Here's health benefits. Your salary is going to be way above minimum wage. Embedded throughout that is a system of trust. That's qualitative. That's not quantitative. You can't do a variance analysis on that. But it's huge.
Trust is such a powerful concept, and it came up in many discussions on this podcast too. It's an intangible quality that's not on the balance sheet. You can't see it. You kind of feel it. And Munger talked about the seamless web of trust and how they would have those early deals with a page or two with no lawyers. Just basically they knew who they're dealing with and they were in. And I think it's really fascinating in all kinds of business and life pursuits that earning that trust, credibility with people has the biggest value, especially if you're responsible for other people's money, their life savings, and they trust you with it. But then in the work that I do, I have clients on one side and the businesses I invest in on the other side, and I need to trust those CEOs, those management teams to do right by me. And I might not be in a position to, chase them and do a proxy battle and force them to do things. I have to assume and choose in a correct and disciplined and deliberate way the right managements to bet on, so that the trust is there and I know that at the end of the day they're playing by the rules and not trying to cheat me. Can you talk about the private and public? I think there are two different worlds. So on the outside it looks like it's the same. You're buying a stream of cash flows here, a stream of cash flows there. But the experiences are very different. And I'm not talking about leveraged private equity deals. I'm talking about actual ownership of businesses in the private market.
Yeah, for sure. The stats on holding periods indicate that a private deal, you're going to be statistically a longer term hold than a publicly traded company. Begs the question, why? My theory would be it's so liquid. For you to sell right now, your position is a couple clicks probably.
Right.
And it's like that. A private deal doesn't involve that. Private deals negotiated, due diligence, lawyers, contracts. It's a longer deal. The opportunities, in my opinion, for, let's call it some inefficiencies, Mr. Market going a little crazy from time to time, are actually greater in public markets. It's very hard to negotiate the best deal. However, there's still opportunities within the private sector, and the key difference is levers of control. So it's kind of neat. I'm in business with some former students of mine. And these former students are trustworthy, and they'll scour and 99 point whatever % of deals get rejected through the due diligence, through the process. You learn a lot in private deals from negotiating, from trustworthy actions, from reputation building. There's also greater risk. It's harder to get out.
Right.
In fact, in one deal that I helped structure, I wrote, hey, listen, all LPs and GPs, you want out within the first 5 years, it's going to cost you dearly. In other words, if you're not in as a long-term person, you don't really belong in the deal. And there's going to be severe consequences for those actions. The other major difference is public companies are forced to have a whackload of disclosure, They're forced to have audit.
Mm-hmm.
They're forced to have regulatory compliance rules. They're forced to have disclosures of risks. That doesn't happen in a private deal. You don't get from management, here's all the risks we possibly identified, right? And so quite different. But as I say, there's a lot alike in terms of you have to be very strict. Is it in your circle of competency? Do you understand everything to the extent of your abilities or what have you? Because you know eventually some unexpected things are going to happen that are bad. So you need a margin of safety. You need to be very strict on purchase price. You need to do your due diligence. I think it was Warren, maybe it was Charlie, who said, I'd like you to pretend after you buy that the market is going to be closed. Now, that same mindset is similar to a private deal if you think about it, right? You're not going to likely be flipping this within a year or two. In fact, Charlie said, your thesis, you won't know if you're right or wrong for till about 5 years. It's best not to look. Close the computer, wait 5 years, then look. And that's similar to private deals. You know, yeah, you can be very, very lucky and things can turn around very quickly, or it could take longer. Both are okay. Or you could be wrong, in which case you need to reevaluate your thesis and add to your checklist and think through the root cause analysis of that. Yeah, those would be the primary differences.
You could have the private market approach to the public market, where you become an owner. You believe you're becoming an owner for many years to come, and you kind of mentally make it hard for yourself to sell. You say, I won't sell it for a year or 5. You can do that. The upside of the public market for me is that there is this anonymous crowd that tends to get enthusiastic and panics together. In the private market, if you have a motivated seller, usually it's probably not something I would want to consider. A motivated seller might have some sort of information that will probably make this time of sale attractive to them, not so attractive to me. I don't know. A new competitor showed up across the street and so on. Or maybe there's things changing, regulations changing, taxation and on that will change the business, and they're really motivated to sell. Unless it's a family disaster and they have to sell, that's different. In the public market, it's a peculiar creation, and we all seem to panic at the same time. You mentioned the range, 52-week range, which I like as a mental exercise, that you can find opportunities that are available in the public market in terms of price that are much, much harder to find in the private market because it's slower, because it's delayed, and because there's not a crowd dumping the shares of this company. It's probably the family that owned it, some controlling shareholder that's selling a piece to you. They should not be a motivated seller. not in the same sense as the public market. That's how I look at it.
One of the things I'm absolutely obsessed with is market cap. One of the things I want to do is figure out what's the market cap of a business. Forget what the share price is. That's not, when I say market cap, I mean, what is the entire business worth? Then I pretend that I have the money to own 100% of it. Then I say, would I buy 100% of it? Of course, I'm only buying a bit of it, but that's not the way to think. In other words, you're not buying shares. You're an owner of a company. The share price has all those sort of fluctuations. In the private world, by the way, interest rates go way down and certain sectors get very, very hot. So in the private world, just like in public markets, you could have a very hot market for certain businesses that are for sale. So you can have a Mr. Market in the private. It's just not as efficient. The swings aren't as quick necessarily statistically. Sorry, and I didn't mention either, tax consequences are huge in private versus public. So there's another element, but another one that's pervasive is because I'm valuing the entire business and I'm pretending I'm buying the entire business, I also need to put myself in the seller's shoes. Why are they selling? For every single transaction, if I'm buying, that means somebody wants to sell. Now you make an argument, yeah, but you're only doing it for small amounts in comparison to the entire, but that's not the way I look at it at all. I pretend I'm buying the entire company. I pretend somebody's selling the entire company. You better understand why they're selling. My due diligence on private companies, by the way, statistically, we buy from individuals who are moving or who are up there in age. Um, the due diligence should root out, oh, there's a competitor opening right across the block and they're going to be bigger and better.
Mm-hmm.
That's your job to find that.
Mm-hmm. So the motivation is more personal. It's age or location change. It has nothing to do with the business. And I understand the cycles and the ups and downs in the private market. In the public, you could have price come down with the market cap at the same time for reasons that are not even real. It's a sentiment-driven sale that's very pronounced and can create an opportunity. But you also always have what you mentioned, the daily temptation to sell, and it's just way too easy to sell. You don't even have to open your laptop. I think these days you can sell with your phone. So that's a very hard thing to practice and not give in. Jeff, you shared with me something that I hope I can bring up that really stayed with me. You shared with me that you have never gone hungry in your life. We were having a conversation and you brought it up, and I hope it's okay if I bring it up here, because that sentence got me really thinking and inspired. I gave some interviews lately and I was thinking about that sentence that you brought up. Can you share with the audience the context and what it means to you that you have never gone hungry in your life, and how does that influence what you do in your life?
Right now, like in all likelihood, if you're listening to this, you're on your phone or what have you, listening on Spotify to Talking Billions.
Mm-hmm.
That's an unbelievable gift that you have the time, energy, and resources to allocate your brain towards this as an endeavor.
Right.
I have never, I felt, hunger, but not real hunger, as in my grandfather described Great Depression. And individuals going through the garbage at school and eating a used apple, like the core, anything of any sort of sustenance. I've never felt that. So I was handed a deck of cards when I was born, which I have no control over, that happened to be amazing. Now, cool. Loving environment, loving family. I'm in Canada, a whole bunch of just aces. Mm-hmm. Now, we can learn from this an attitude of gratitude. If you were to offer me to be a Rockefeller when they were, at the equivalent of modern day billionaires, or my life, I'll take my life. Better travel, more comfort, better healthcare. So, okay, I'm a Rockefeller in my own mind. Now, of course, I don't have the equivalent net worth, but you already heard me say, I don't want to be Bill Gates, the modern day Rockefeller. Gratitude to me is a remarkable lens. Or if you study Arnold Vandenberg, an individual who survived the Holocaust and malnourished, and he to this day repeats mantra to himself, I am happy, healthy, wealthy, and wise. He reprogrammed his own brain, became the #1 rope climber in Europe after being malnourished. I think that this is a pervasive, unbelievable approach. It's, by the way, borrowed from Stoicism as well. So when my Burke stock goes down, does that, in other words, forget Berkshire, something bad happens. You have the exact same external stimulus. You have two individuals. One will react with extreme pessimism and negativity, and it'll make them very, very upset. Another individual will have a very different reaction. And from this, we can learn once again from Charlie. Charlie, within 1 year, lost his son to cancer, is divorced, horrific. And he said he was wandering around downtown, just lost. And he made a decision that he will never feel sorry for himself, period. He will always choose to put one foot in front of another. Well, this attitude is unbelievable. And by the way, useful in all areas of life. If you think about it, another way of saying this is, do you have an internal benchmark? In other words, are you internally going, I'm going to react to this, right? Not by what other people think, but what I think. This is where you end up, by the way, saying, my goal is not to be Bill Gates. My goal is to be better than I was yesterday. If you do that, and I'm not good at doing it every single day, but if you do it enough, if you try to be just a little bit wiser, that compounds just like a good company does.
Wow, so many beautiful things that you brought up. William Green, Richer, Wiser, Happier podcast, had a wonderful interview with Arnold van den Berg. Probably 2 interviews if I remember right, but what a remarkable story of what he overcame, and he's in the investment business, and just every time I listen to him, I mean, his voice, there's so much joy, enthusiasm, and passion for what he does. It's just remarkable, and I feel like it's somebody worth listening to, learning from, and emulating in as many ways as we can. And speaking of him, I was talking to somebody about him the other day, how his accountant was looking at his tax returns. I hope I remember the story correctly, but basically his accountant was telling him to maybe pick a different career because people with less talent and less smarts are making more money than he is. But he was so passionate and committed to being an investor and investing money for other people that he kept at it. And I thought it's such a powerful idea, whatever pursuit you choose in your life, that if you know that this is the only thing you have to do, it doesn't matter that your tax returns are not impressive yet.
100%. If you think about the way Richer, Wiser, Happier, that's one of the top book recommendations I'd ever have.
So good.
And if you think about how he wrote it, yeah, it's unbelievable. And, here's Sir John Templeton and here's, just titans of individuals who beat the market and were unbelievable and multi-decade invested. And who does he end with? In other words, William Green is trying to teach him a lesson to the reader. And I believe the lesson is not purely pursuit of wealth is the ultimate and the end game of life. He's saying, look at Arnold.
William Green was on this show as well a few months ago, and we talked about authenticity. So if anybody listening, you can look up that episode. But it was such a fun conversation, and he brought up all the ideas that you're talking about now. But just being authentic and real in life and honest, something we started with at the beginning when you're discovering your investment philosophy, your own investment philosophy, to be honest with yourself. What is it that works with you, for you, not just what your heroes are doing? You brought up books, and since you read a book every week, do you have a book recommendation? I haven't asked anybody for a book recommendation in a while, but is there a book that you think would maybe surprise the audience, maybe an unexpected experience with a book, something that was kind of almost a shocker, like, wow, I'm glad I found this book. Maybe even a book that you wish you had in your hands, 20 years ago.
Okay, I'm going to take the question in different directions, because why not? Behind me here is poor Charlie's almanac. Mm-hmm. So Charlie's always staring at me as I talk. Whenever I give lectures, I could feel his eyes. And that's a healthy lens for accountability. Because who is really smart enough to stand up to Charlie's eyes? But okay, so poor Charlie's almanac. Richer, Happier, Wiser would also be on the list, and so would Common Stocks, Uncommon Profit by Fisher.
That's a good
that's
one.
like the classics. And by the way, Richer, Happier, Wiser, because it's not a pure investment book, it's a philosophical book. It's a lessons learned from these lives. In other words, there's a lot of power. By the way, when I finished that book, that was the first time I ever wrote a letter to an author, because I was exhausted knowing the amount of effort that went into 30 or 40 years of work to produce that book. Okay, now to answer your question.
Yeah.
It's unbelievable. A surprising or an unexpected book. I'll walk you through a couple. One is called Mission in a Bottle. Mission in a Bottle by Dr. Nailbuff and Seth Goldman. Have you ever heard of this book?
No, I love the title.
No worries. It's written in a comic book form, but it's a business book. And Dr. Nailbuff is an expert business strategist. And they created a company that sold high quality iced tea. Now you can imagine who
Mm.
your competitors are, produce iced tea. And they start off the book with some questions. Why is it that Coca-Cola wouldn't crush them like a little bug, um,
Hmm.
trying to break into the iced tea market? And the answer, it shook me. It rattled my brain. It's like, oh, well, that's easy. It's not even a risk. I'm like, how is that not a risk? And the answer was, it would be cognitive dissonance. They're already producing iced tea. They'd have to acknowledge that their own iced tea isn't really good quality iced tea. And so they can't do that. And
Uh-huh.
I'm reading this, and my brain was just shook.
Hmm.
And by the way he structured the financing of the deal, he needed investors to get things going. He said, listen, if we fulfill our role as management, we're going to end up taking equity from you. You bought in at 10%, you're going to end up with only 5%, but it's going to be 5% of a way bigger. But if we suck as management and we don't do what the plans, you'll end up owning my shares. You'll take it over. You could fire me. The aligning of incentives, right? And
Hmm.
incentives are super important. So you can see why this book is on my list, and a little bit surprising for a comic book,
I
but that's the
like that.
format that it's written in. Um, and I'll give you one more, because I guarantee of this audience, most people will have not read it. It's called The Entrepreneurs. It's the story of Gendis. And this book is from I don't know, 1980s.
Uh-huh.
The longest partnership that Sony had with any private company in the world was a company in Canada, run by the Cohen family. And it's called, The Entrepreneurs, the story of Gendis. And a remarkable story. And I like reading biographies, business stories. Yeah.
Oh, great recommendations. Mission in a Bottle and Entrepreneurs and a couple of classics that you brought up.
Sorry,
Jeff,
one more,
yeah.
because I don't know if we're gonna have time for me to tell the entire fraud story. Here's a fraud story. Empire of Deception. Uh,
Uh-huh.
I love fraud books too. So there's another one for you.
Fire of Deception. Wow, remarkable title. I want to ask you about your definition of success, but before we get there, I'm very curious, and I brought this up in this show many times, how investing can be a lonely pursuit. You sit down, you read, you do your research, but we all need a community, and you and I are part of the ValueX community. Can you share about the importance of being a member of a like-minded community that allows you to connect, share, get inspired, and even lead to conversations like this one?
The first time I got up to speak, um, Guy Spear, after my talk, used the opportunity to shine a light on somebody else.
Mm.
So he said, "Hey, could you please talk about? We have a mutual friend. His name is Herman Peterstruck. He runs a little fund, um, and what a way of compounding kindness. Guy didn't want the light on him. He didn't want the light. He wanted to shine the light on somebody else, and I see him continually doing this. Right?
Mm-hmm.
He's compounding kindness. He's done way more good for me than I've done for him. I try to add value, when we have meetings or what have you. Um, but um, this is an individual I want to be associated with. This is a quality individual. Um, as I say, lots of things in life can compound, and
Mm-hmm.
compounding kindness is a remarkable pursuit. Um, our walks, in gorgeous Swiss Alps and all that kind of stuff are remarkable too. The I pitched a stock, to a fellow investor, and they have a large fund,
Mm-hmm.
and they said, "Oh, it's a microcap. It doesn't have the liquidity for the size of fund that I have. Right? It doesn't meet the minimum criteria." And he's like, "But I think your investment is correct. I like your thesis. I like your due diligence. Da da da." And I said, "Great. Why don't you invest in it personally, not in the fund?" And he said, "I won't. Almost all my net worth is in the fund. I want to do what's ethical for my investors." Um, and you know, you hear that as a response, and you're like, "I just want to be around these people."
Mm-hmm.
It helps. share knowledge. It helps sharing ideas. It's done with individuals of high quality, of individuals who you could learn from. It's a supportive environment. I
Mm-hmm.
like that there's individuals there who are experts in cryptocurrency.
Mm-hmm.
Um, I sat down for a drink and basically interviewed the heck out of it. Walk me through this. Walk me through why this is. No, I now the what am I doing? I don't mind telling you. I have $100 in cryptocurrency. I bought
Mm-hmm.
it because I wanted
It's
to
not
run
an
the experiment.
endorsement.
And right, exactly. And confetti came down from the app. It was trying to gamify me. It started sending me things. You're now a trader.
Mm-hmm.
You're now a crypto trader. You're now an investor. All this is very dangerous in my lens. I see
Uh-huh.
gaming, right? Like really
Uh-huh.
the analogy that comes to mind. However, that fellow investor, I would be doing myself a disservice if I didn't go down the rabbit hole and start learning. That doesn't mean I need to act on it. That means I need to seek to understand it, if that makes sense. The environment is not one of preaching,
Mm-hmm.
right? You should, you ought to, you're making mistakes. It's one of sharing of knowledge, which is a very healthy environment. This is a group that I think, brings people up. Um, I was once talking to a fairly prominent CEO, actually at Berkshire, and I'm like, hey, I've asked you question after question, about your company, but do you have any, thoughts that you'd like to share with me outside of your company? And he's like,
Right.
yeah, your network is one of the most important things in your life. You want to be with people that raise you up by being
Mm-hmm.
associated with them. It's one of the most powerful things you can do. Well, that to me is value X.
I love the sound of that. When I came back from Omaha and I went to VALUEx'er in Omaha as well last year, I wrote an article that I called Return on Kindness, which is a borrowed idea, I think, from the founder of Chobani. And I came back from this event and I got to see a lot of VALUEx friends and other friends. And I was thinking, how would I summarize it to somebody that has never been to Omaha and experienced it? And I thought kindness is the word. There's a company, there's shareholders, there's a hero of us all, and then on stage for a whole day answering questions. But what is it really all about? And we talked about trust today. I think kindness is equally important, and all those things make life more enjoyable and allow things to happen in places there where it would be tricky to have things happen, and the environment that you create plays a role. Jeff, before I let you go, share with me and the audience your definition of success. How do you think about it?
So one of the first things that I would say would be, uh, in order to have what I would call, I don't believe in happiness. Happiness is like short term, right? You get the thing, you're happy, but that's a short term. Contentment is a better pursuit. In order for me to be content, I've divided things up into four major categories. Number one, by the way, they're not in order. You need personal well being. So,
Mm-hmm.
take care of yourself, eat right, the exercise, da da da, that compounds as well. Great. Next thing would be you need to have um, what motivates you, what fills you up. So, for example, for me, teaching is one of those things. I have a passion for it. I like it. Um, so you need a job, a profession, activities that are in line with you.
Mm-hmm.
And the other thing that I think is important with that is you need enough finances to do what it is that you like to do. So for me, that's the
Right.
pursuit of independence. I want independence. That's why. The next is family and relationships,
Mm-hmm.
which is massive. And if you think about it, we're all on our way to a grave. So, that's going to happen. And people are not going to spend a lot of time talking about how healthy you were. And people
Right.
are not going to spend a lot of time even talking about your job, but they will talk about your relationships. They will talk about the
Mm-hmm.
family. Um, my grandfather's long passed. The lessons live on. That to me is very cool and very powerful. And last and is not least is I believe there's an obligation to give back. And give back is not purely philanthropy. It's time. It's giving back to community. Your podcast, I would argue, is a way of giving back. And so, you can look at it from that angle. I would also define success, because I'm a student of Charlie, as inverting it. What is it not?
Mm-hmm.
Well, how would you guarantee a life of misery? And Charlie teaches you how to do this. All you have to do is overspend your income every single year and try some highly addictive substances that are bad for you. All you have to do is be untrustworthy. Don't act with ethics.
Mm-hmm.
Make a commitment and then don't follow through on it. Just try never changing your mind. Watch what'll happen, right? So we could invert it. Another way that I would define success, and this was a very powerful lesson. When I teach, I frequently talk about this. Pretend that you needed to invest 10% of you're going to own 10% of somebody else's whatever income stream they bring in for their life. Who would you choose? Now, picture in your mind, right? You're going to own 10% of whatever they earn for the rest of their life. Now, you could argue, okay, well, I'm going to pick somebody with a huge inheritance coming. I get it, fine. You could also say, I'm going to pick somebody young. I get that too. Longer, tail.
Mm-hmm.
But think about the qualities of that individual. And if you start walking through the qualities of that individual, you quite quickly end up with ethical framework, integrity, individuals who know how to communicate, know how to motivate, individuals who know how to delegate a team, individuals who inspire, individuals who are going to where the ball is going to be, not chasing after where the ball is already been. Individuals who aren't afraid of failure, right? They're not afraid to try. Because you've studied successful entrepreneurs, almost all of them have had some fairly massive failures, but they're going to choose perseverance. It doesn't make a difference if they fail. They're just going to pivot and move forward and keep on going. And then Warren, when he gave that lecture, to one of his talks, he said, yeah, but you're never going to own 10% of anybody, but you own 100% of you. Copy those good characteristics. When you see the bad characteristics in individuals, remove them. That would be my definition of success. And by the way, I'm not there yet.
Yeah, but I love what I'm hearing. And I like this idea when you flipped it on its head at the end and you said, you're going to own 100% of you. How about you give it some thought? What kind of an individual you want to be in this world? I think it's a very powerful idea that you do have a choice. And you can choose what you not want to have and what you do want to have. And over a lifetime, it compounds. Jeff, this was such a remarkable conversation. You and I had such an ease of talking at random moments at the various VALUEx'er events, and I knew that if I have you here with a microphone and a couple of pointy questions, I'm going to get some wonderful insights. So thank you for sharing today, and I loved your grandpa's story and some powerful images and ideas that will stay with me, even more so than the few conversations that we had since. Just this hour was very special, so I want to thank you for today.
The feeling is very, very mutual. I look forward to upcoming chats. Keep on being
Thank you. We might have to do it again, Jeff.
Oh, yeah. If you want some fraud stories, yeah, that's no problem. I can
We'll
take
do
up
a
a couple
spin-off
hours
episode.
more.
Well, bye for now. Thank you so much.
Thank you.